Welcome back, folks. This is the second part of the presentation, the theory presentation on the income statement. In this topic, we're going to talk about the income statement, a little bit how it's structured, and then the chart of accounts. We're not going to actually do an income statement. We're just going to kind of talk about the theory and stuff behind it, and then we will do an actual income statement, what it looks like in a separate lesson. So, one question I often get is when people think about bills, and it's kind of like paying a liability, it's a little bit confusing. When we think about pluses and minuses and good things and bad things, and it gets very confusing. So, one thing that we need to really kind of keep in mind with expenses is even though we want to keep what we owe at zero, when it comes to profit and loss, we're not really keeping track of, we're not really worried about keeping track of what we've paid at that point. We're keeping track of what we've used, which is kind of a different question. And so let's have a look at kind of this chart that I have here. So supposing that you bought a new cell phone and you signed up for a new cell phone service, and that service cost you $30 every month, all right, just for the sake of argument. So we would, as you know, being good, money managers and being very careful with our money and wanting to have a good credit rating, we would want to make sure that every month we would pay off our bill when we received our bill. So, so theoretically, then at the end of every month, we get charged $30, we pay $30, and we owe nothing. All right, which is good. That's good money management. But for the purpose of an income statement, we want to keep track of how much of that service we've used. Whether we've paid it or not is really a different question. If we are using up $30 worth of cell service every month, how much would that be? How much would the total expense be? So another way to look at it, suppose you had budgeted $100 for 3 months worth of cell service. In this case, you would have spent $30 on it in the first month. You would have spent another $30 in the second month. So now your total is $60 that you've used. And then the third month, you've used another $30, which again, even though you've paid it all off and you owe nothing, in the third month, you've now used up $90 worth of that service. And so if you had budgeted $100 to cover all your cell services, you would have $10 left over. Well, running a business is really very much the same. And so even though we've paid off our bill every month, we've used up $90 worth of cell service. And that's what we need. That number, that running total, is the number that we use for keeping track of income or loss. And so whenever you pay a bill, or when you receive a bill, as we're going to see, you're going to, in this case, you would debit the expense account, which is like cell phone service. You would debit that account for $30 each month. For $30 each, which would add up to $90, would represent $90 being taken out of our capital account, basically, right? It would count against the revenue and would affect how much profit would go into the capital account. So the income statement then, by definition, is a financial report that shows the revenue of a business, subtracts its expenses, and then reveals or calculates the profit made for a given period of time. It lists only the revenue and expense accounts. As they say in math, you have to show the work. The purpose is to calculate or show the net income or loss. We don't typically use profit in accounting. We use the term net income. And net just means, as we're going to see in a minute, it just means that we're subtracting. It's not anything very mysterious. Whenever you see the word net, it just means that something has been subtracted. We do not include the capital or drawings account on the income statement. We will learn how to do that as part of the closing process. So then a couple other definitions. Revenue is any increase in equity resulting from the sale of a good or service during the usual course of business. So we've had a few different services, whether in our work so far, whether it's lawyer or accounting, legal or accounting services, shoe repair services. We've just been kind of keeping it simple that way. all that money would show as a credit to the revenue account. Often, and certainly in our work, there can only be one account, but there can also be many revenue accounts depending on how big your business is and what you do. Expense accounts are decreases in equity from the cost of operating a business. So again, we've already covered a lot of examples. Anytime you pay a bill, whether it's for rent or electricity, anytime you pay for staff, anything like that. And oftentimes there are loss accounts get set up. So if you have damaged equipment, you would have a damaged equipment expense account, for example. And so then the net income or loss, whenever you hear the expression the bottom line, that's what this is referring to, because the profit or loss is always showing on the bottom line of an income statement. And so when somebody wants to know what the bottom line is, what they're really asking is what's the end result, what's the end product, what's the end problem, what's the end question, and or the end answer for that matter. So in this case, an accounting perspective, it is the net income or loss. It is always calculated by taking revenue and subtracting expenses, hence the word net. If you have a positive answer, so if you have, thinking about it logically, if you have more revenue than expense, so you brought more money in than you paid out for bills, you have net income. So you've made money and your capital account is going to go up. If the answer is negative, then you have a net loss. And so often, just as a side, we've kind of talked about this before, in accounting language, usually the losses or minus numbers, negative numbers, are shown in brackets as opposed to having a negative number. Anyway, what that means is that the business has lost money. We had more expenses than revenue or that we brought in. Very hard to stay in business for very long if you are continually having net losses. And so then for the uses for the income statement, we talked about a lot about decision making. That would be for owners and managers, bankers, investors. So how much money did we make? Why did we make or lose the money we lost? How can we make more? That's always a business's legal requirement, is constantly be looking for ways to make more money. Bankers typically want to know this because you are asking them for a loan and they want to know how you're going to pay them back. Investors want to know because they want to know how much the business is going to grow this year and over the next few years. And then governments want to know because they want to make sure that you are paying the correct amount of tax on the profit or net income that you've made. So the next thing we're going to do is we're going to talk about this idea of sort of the drawings and also the chart of accounts. So the drawings, as we said earlier, it represents money that the owner has withdrawn from the business for personal use. So for instance, if the owner shows up at your desk and says, hey, I need $1,000 out of the company business or the company account, you will say, fine, sure, just show me, the memo or email or whatever, and you will process the transaction. Usually you'll give them cash or a check, which comes from the bank account, which would be a credit to the bank account. And the increase in a withdrawal is kind of like an expense. So it's going to be a debit to the drawings account. This is kept separate from the expenses, as we will see. So one thing that is, I'm sure you've figured out by now with accounting, is that people that are in accounting and the accounting processes are very, very, very organized. And the problem with life is that it's not very organized. It changes and things happen a lot, and business increases and decreases, the kind of business changes. And so it's really important to have a system in place that manages the number of accounts and the account names that are being created. If you don't, a lot of confusion can happen. You can get like a lot of duplicate accounts, or you can have accounts that are missing that should have been added, and so the values go to other places. It just causes a lot of problems. And so what accountants do, especially like the head of the accounting department, will create what's called a chart of accounts. And a chart is basically of accounts as an outline of how the accounts are going to be numbered. Typically, accountants like accounts to be numbered because it reduces the amount of confusion over what to use. The numbers, as you'll see, that are assigned in order that they would appear in the ledger. There could be like our accounts, businesses we've dealt with like a dozen accounts. There can be hundreds, even thousands of accounts. So even more reason to have a system to keep track of them. We also need to make sure that we have a system for adding and taking accounts away, and to having them maintained in the correct order on the balance sheet. And then, and again, even just to be able to look at an account and look at an account number and have an idea about what kind of an account it actually is. So this is a sample of a very, very simple chart of accounts, all right? So without really kind of defining exactly what account is going to have what number, what the chart does is assign ranges that are pre-designed to have enough space to handle all the possible accounts that we would have. So in this example, all of our asset accounts are in the range of 100 to 199. And so we would expect that this is a small business and that having that we would never have more than 99 accounts, asset accounts in it. If we were concerned about that it wasn't enough, then we would expand our range. Now, these numbers are arbitrary. I mean, if you wanted to have assets numbered from 500 to 1,000, you could do that. But the main thing is two things. One is to make sure that you have a wide enough range to keep to have space for all the possible asset accounts you have, but also that the ranges are in order. So you'll notice here that our asset accounts, which appear first on the trial balance, are start with 100. The liabilities accounts, which would come next, are all in the range of 200. So these are listed in order. The capital account, which would then come next, is in the 300 range. Presumably, you would only need one. Same with the drawings. And then we have the 400 range for revenue, which is the next type of account that would appear. And then finally, we have our expense accounts, which are in the final range. So again, making sure that A, you have enough space, and B, that you have them in the order that they would appear in the ledger. Now, here is an example of some assigned account numbers that would fit to that chart of accounts. So when I'm looking at this new listing of accounts, I'm going to expect to see all my asset accounts listed in order from 1 to 199. So here we have our asset accounts. And so just kind of defining or looking at where the things take place. This is not a balance sheet, so don't be worried that the liabilities are over here on the left. But you'll notice that all my asset accounts are listed in the 100 range, and they're in order. So bank, which would always be first, is listed first. It has the lowest number. My three accounts receivable in alphabetical order by last name, they are also numbered accordingly, right up to my last account, which has got the highest number. Now you're looking at this and saying, well, wouldn't bank be listed as, number 100 or 101? Yes, you could, but you'll also notice that there is space before and between each of these accounts. And the reason that we do that is to have room to add new accounts. And so if I had for some reason, some other bank account, like maybe petty cash that had a lower value in it, I might want to list that first. And so I would need to assign an account number like 103 or 104. If my bank account had been listed as 100 or 101, there wouldn't be any space to add an account before that. And so that's what that space is for. When you do this, it really doesn't matter how much space you put in between, as long as it's consistent. If you want to put 3 blank spaces in between each one, you can do that, or 7, whatever, as long as, again, they're in increasing numerical order, and there's space for expansion. And so then going on, then we see we have our liabilities, which are all listed in the 200s. We have our equity accounts, which are listed in the 300s. Then we have our revenue. In this case, we only have one revenue account. And then our expense accounts, which again, in alphabetical order and listed in increasing numerical value. And that question about how the numbers are assigned is to leave space in between each one to add new accounts. And that is the end of this lesson.